All right, so chapter 3, like I said, we're going to be dealing with something called the adjusting process. So as I mentioned before, in chapter 2, we were journalizing those daily transactions that were happening in a business. So every time we purchased supplies or equipment, or we provided a service on account, or we paid our rent, these things were happening in real time, and we were recording those transactions. Excuse me. At the end of every month, companies have to do this adjusting process. And what the adjusting process is really updating the balances in certain accounts to ensure that they appear reasonable on our financial statements. So we follow something called the accrual basis of accounting, and you've basically already been practicing this in chapter 2, but what is that really saying is that we are not following a cash basis. So we are not going to only record a transaction when we receive or pay out cash. We're going to record them as they take place. So for example, when we earn revenues, we provide a service, we've completed a job, we record that revenue even if that customer doesn't pay us right away, right? So we debit our accounts receivable, we credit that fees earned. Same thing if we're dealing with our expenses. So we might have a utility expense that we got in the mail, but we are not paying that bill until next month. That creates that accounts payable for us. So we're focused on that accrual basis, and that is required by GAAP, which again stands for Generally Accepted Accounting Principles. And that causes us to have to do this adjusting process. And again, the adjusting process is really going to be updating certain accounts at the end of the month. So there's 2 basic types of adjustments that we're going to do. The first one is called an accrual, and that happens when revenue has been earned or an expense has been incurred during the period, but we just haven't recorded it yet. So in an accrual entry, both accounts that are affected are going to be increased. So we know that from chapter 2, every journal entry has to affect at least 2 accounts. In this chapter, that does not change. And in this case, both of the accounts that are going to be affected are going to be increasing. So that's something to kind of keep in mind. So a great example of an accrual would be if you were a landscaping business. So if you have a landscaping company and all of your landscapers go out for the entire week and they're going house to house, they're, cutting lawns and planting flowers and raking up leaves, they're probably not coming into the office every day to tell you what they did. At the end of the week, they'll come in, say, here's all of the jobs that we completed. Here's all the customers that we've served. Now you need to go ahead and process bills to send out to those customers. That's what we're talking about in terms of an accrual. Same thing when you're thinking about on the expense side. I know it happens to me. I'm sure it happens to all of you, right? The other day, I got my electric bill for last month's usage. So it happened last month. It helped me keep electricity going in my house last month, but I'm going to pay it this month. So that's what we're talking about as an accrual. It's something that has taken place during the current period. We just haven't recorded it yet, and we haven't either received or paid cash out for it yet. On the deferral side, when we think about the word deferring, we are postponing something. And what we have done is we have postponed the recording of a revenue or an expense until it's actually happened. So one of them that you'll be familiar with from what we did in chapters 1 and in chapter 2 are supplies. So we said when we go out and we purchase supplies today, they're an asset for my business. But I'm not buying office supplies just to stock a closet to have tons of pens and pencils and paper for no reason. I'm doing that because I intend to use those supplies to help my business run and operate. So supplies would be a great example for something that needs a deferral adjusting entry. I'm postponing recording those supplies as an expense until I've actually started using them in my company. So that's what we're going to be talking about in terms of deferrals and accruals. So again, think deferral. We've postponed or delayed the recording of a revenue or an expense until it actually happened. The accrual, it has happened. That revenue or expense has taken place during this period of time. We just need to record it. So as I mentioned a few minutes ago, we're going to do a lot less journalizing in this chapter. Chapter 2, you might have had 20 or 30 journal entries that you had to do for a month. In the chapter for adjusting entries, you might only have 4 or 5 or 6 adjusting entries that you have to do because not all accounts are going to require an adjusting entry. So I give an example here. Cash and owner's equity, our capital, our drawing accounts are never going to be part of an adjusting entry. Those are accounts that are updated on a constant basis. This second bullet point is really important, and it's something to kind of help you kind of double check yourself when you're doing your adjusting entries, and that's that every single adjusting entry you're going to do is going to affect a balance sheet account, meaning an asset or a liability, and an income statement account, meaning a revenue or an expense. So every single adjusting entry has to affect one balance sheet account and one income statement account. And every adjusting entry is going to be increasing that revenue or that expense. And the adjusting entry will always be recording what we've earned, meaning services we've provided, or what we've used. So how much supplies have we used? How much in prepaid insurance has expired? So we're going to look for some kind of keywords and phrases to kind of help us identify what has been used or what has been earned. But those are 3 really important points. Again, every adjusting entry affecting one balance sheet account and one income statement account. Every adjusting entry is increasing a revenue or an expense, and every adjusting entry, the amount that we record in our entry is always going to represent how much we've earned or how much we've used. So the first one that we have is a prepaid expense adjustment, and this is a deferral adjustment. So this is exactly what I was just talking about with our supplies. It's something that we've initially recorded as an asset, but we are expecting it to become an expense, either through the normal operations of our business or through the expiration of time. So when this happens, our asset account is going to decrease and our expense account is going to increase. So asset account's on our balance sheet, expense account is on our income statement. So some examples with this, again, would be supplies, anything that's been prepaid, so prepaid insurance, prepaid rent, all of those would be considered a prepaid expense adjustment. And I've included some keywords and phrases for you to pay attention to when you're dealing with the adjusting entries. So anytime you see the phrase on hand, they are telling you how much of that asset the company still owns. Remember, what goes into my adjusting entry is always what we've earned or what we've used, not how much we still have or still owe. So something to keep in mind. The used amount would be your expense amount. So that again would be the amount of your adjusting entry. If you see the term unexpired, unexpired again is the amount of the asset that we still own versus expired, think expense. EXP goes with EXP, and that would be the expense amount, how much we've used of that insurance or that rent during that time frame. We also have an unearned revenue adjustment. This is also a deferral. So it's something that we initially recorded as a liability, our balance sheet item, but we're expecting it to become a revenue, our income statement item. So our liability account is going to decrease. Our revenue account is going to increase. And you'll see with these deferrals that our income statement accounts are increasing because we said they always have to be increasing, and our balance sheet accounts are decreasing. So perfect example of an unearned revenue adjustment would be for gift cards. So if we now know that we have had some people come in and redeem their gift cards, we no longer owe as much to that person. So we want to reduce what we owe and increase what we've earned. We've now provided them some services, we've sold them some product, whatever the case may be. And there's 2 pretty long phrases that I put in here to pay attention to, and this will kind of make a little bit more sense when we get into doing some of the examples. But if you see the amount of services provided or earned during the period is, they're giving you the amount that's been earned, that is the amount of your adjusting entry. However, if they say that the balance in the unearned fees or revenue account at the end of the period is, they're telling you how much you still owe, and you need to calculate then how much has been earned. So again, some keywords and phrases to really pay attention to. This chapter, I always say, wording becomes vital and it gets a little tricky. So really pay attention when you're reading each one of the transactions to pay very close attention to what they're giving you. Are they telling you it's expired or unexpired? Are they telling you it's on hand or used? Are they telling you what was earned or what you still owe? So paying attention to that's going to be important. We then have two types of accrual entries, and we have an accrued revenue adjustment and an accrued expense adjustment. So an accrued revenue adjustment is exactly what I was just talking about with that landscaping business. We've provided a service, but we need to bill our customers, and we just haven't recorded it yet. So every accrued revenue adjustment is going to increase our balance sheet account, our asset being accounts receivable, and it's going to increase our revenue account. On the flip side, our expenses are always going to be increasing the expense account and increasing the liability account that's associated with it. So deferral entries, balance sheet account goes down, income statement account goes up. Accrual entries, everything is increasing. Our balance sheet accounts are increasing as well as our income statement accounts. And then the last one we have is depreciation adjustments. So we talked about how the definition of an expense is any asset that has been used to help run and operate the business. So if I go out and I'm a delivery service company and I buy a whole bunch of delivery vans, the whole point of me buying those delivery vans is to use them to help run and operate my business. By using those delivery vans, they start losing value. So just like we start to eat away at our supplies, we're eating through the value of that asset. So we have to do something called depreciation. So it's any long-term asset that we have, meaning a life that's longer than a year, excluding land. So buildings, equipment, machinery, vehicles, all of these types of assets would be depreciated over time. And we won't get into calculating depreciation until the end of the semester. So the amount that they give you in the transaction will always be the amount you put into your journal entry. And basically, it's just the estimate of how much of that asset's original value has been used to help keep that business running and operating. So our journal entry, always to record depreciation, is a debit to depreciation expense, which of course is our income statement item, and a credit to something called accumulated depreciation. And this is in fact a balance sheet item. And when you get into chapter 4, you're going to see how that gets put onto our balance sheet. But accumulated depreciation is what we call a contra asset account. Contra meaning conflicting against an asset account. So it is on our balance sheet, it is in the asset section, and what it's going to do is it's going to reduce the value of a particular asset. So again, if I have a delivery vehicle that I bought for $70,000 and I've now used it for 6 years, there's no way that it's worth $70,000. So I can't just leave it on my balance sheet as I have an asset worth $70,000. Because if I had to sell that asset tomorrow, there's no way I'm going to get $70,000 for it. So below that, I would list out the accumulated depreciation. So yes, I got it for $70,000. I think $50,000 of that I've eaten away at. There's 100,000 miles on it. So really what we call its book value would be the $20,000. If I had to sell it today, I'm more likely to get close to $20,000 rather than the $70,000 original value. So we have prepaid expense, unearned revenue, accrued expense, and depreciation. So we only have 5 types of adjusting entries. And again, not every account that we have is going to be affected by an adjusting entry. So let's get into doing some adjusting entries. And again, wording becomes important for us. So it tells us in this first one, at the end of the current year, $17,555 of fees have been earned but have not been billed to clients. And they want us to journalize the adjusting entry to record the accrued fees. So we only have 2 types of accrual entries. We have accrued revenues and we have accrued expenses. And we know fees go with our revenue, right? Fees earned. So let's say on December 31st, accruals, something happened this period, we've earned something in terms of revenue or we used something in terms of an expense, and we just need to record it. So I have accounts receivable. Again, it tells us have not been billed to clients, meaning I need to send my clients a bill for those services I've provided of $17,555. So that amount is getting put right into my journal entry. It's telling me how much we've earned during this period of time. So that gets added right in. It's going to get posted then to my ledger. It's going to update my trial balance. It's going to update my financial statements. In the next one, it tells us that Prospect Realty Company pays weekly salaries of $27,600 for a 6-day work week, Monday through Saturday, and they want us to journalize the adjusting entry, assuming that the accounting period ends on a Friday. So again, my employees, as much as we like to say that they're assets to our business, they are not in terms of accounting, they are expenses. They are helping us run and operate our business. So they tell us that we're paying weekly salaries, so we're going to have a salaries expense. And they tell us that our employees work Monday through Saturday, but the accounting period ends on a Friday. So let's say September 30th is a Friday, October 1st is now going to be the last day of our work week, and then they're going to get paid the next day. We need to capture what happens in a business in a particular month. So we need to make sure that even though Monday through Friday happened in September and Saturday happens in October, we have to make sure we're splitting that expense between the 5 days in September and our 1 day in October. The other thing that you're going to notice in this chapter is we start to become a little bit more specific about the payables that we have. So in chapter 2, we kind of had just one generalized accounts payable, and that was for anything that we purchased on account. Here, we're going to be a little bit more specific about what we are in fact paying. So anything that ends in payable is always going to be a liability to us. So we're going to have a salaries payable. This is going to be who I owe money to. I owe money for salaries to my employees. So I have $27,600 that my employees earn when they work a full 6-day work week. But in this current month, so let's say it's December 31st, in this current month, only 5 of those days are falling into December. That last day and Saturday is going to be on January 1st. So we have to then multiply it by how many days that were earned in this current month or used in the current month. So 5 days they worked for me in December. They helped me run and operate my business in December. They helped me generate revenues for my company in December. So those 5 days need to be included as an expense for my business in December. Again, think about your financial statements. Think about your income statement. We do revenues minus expenses. Well, if I earned a whole bunch of revenue in the month of December, I need to have those expenses that helped me to earn those revenues on that same financial statement. So if my employees worked 5 days at the end of December, I need to include that as an expense for us. So if we do at our math, we have $23,000 out of that $27,600. That would be an expense during the month of December. Next one, on June 1st, 2019, they tell us that our company received $18,900 for the rent of land for 12 months. So they want us to journalize the adjusting entry required for unearned rent on December 31st. So again, this is where you really want to pay attention to wording. Again, we only have 5 different types of adjusting entries. We have prepaid adjustments, we have unearned, we have our accrued revenues, our accrued expenses, and our depreciation. Well, right here, they have the word unearned. So we know that we're doing an unearned revenue adjustment. That means our liability has to decrease, our revenue has to increase. So we're doing this as of December 31st. So on June 1st, someone walked into my company, they handed me a check for $18,900, and I have done nothing for them. So that's what makes it unearned. Remember, our revenues are always earned when we've actually provided a service to our customers. So that $18,900 is sitting on my books as a liability. I owe that customer the right to rent my land for the next 12 months starting on June 1st. But as of June 1st, I've technically done nothing for them, so I've technically not earned any of that money. But now some months have passed, and so now I have earned a portion of that $18,900. An entire year has not passed, so I haven't earned all of it, but I have earned a fraction of it. So I want my liability to go down, and I want my revenue to increase. And we're going to make it specific that it's our rent revenue since they told us it was unearned rent. So we have $18,900 that we received for 12 months of rent. And we're going to multiply it by how many months we've earned. And this is something else I'll point out to you because this will throw a lot of people to say June to December, that's 6 months. Remember, it's June 1st to December 31st. So that means my customer rented that land and was on my land all of June, all of July, August, September, October, November, and all of December since it's December 31st. So 7 months have actually been earned by our company. So out of the $18,900, I have earned $11,025. And again, if we think about this in terms of a T account, think about a little mini general ledger here, we can look at this and say, okay, how would we kind of put this together for our business? So if we give ourselves a little T account, an extra line here. So when we originally got the money, it would have been a credit. Our liability would have increased of $18,900. I think that's our unearned rent. And then this is our beginning balance that happened on June 1st. And then we actually just reduced it. So $11,025 is what we reduced because of our adjusting entry. And that was done on December 31st. So now if we take a look at this, we update, we know opposites subtract. So I had $18,900 that I owed to somebody in terms of services. I just provided them $11,025. That means I still owe them $7,875. Which again, they paid 12 months in advance. I've earned 7 months. So that gives us what our remaining months are here. So I have to provide them month 8, 9, 10, 11, and 12. So I get 5 more months that I have to provide to them. And we can kind of double check our math here. If we did 18,900 divided by 12 months, we earn 1,575 per month times 5. Tells me how many months I still owe. So I'm reducing my liability. So when I put my financial statements together, it's not going to show that I owe anybody $18,900 in services. It's only going to show that I owe them $7,875. So that updating process that we do. We're going to do another one with unearned fees. And again, this is kind of getting back to the phrases that I were talking about in those PowerPoint presentations. So this one tells us the balance in the unearned fees account before any adjustment at the end of the year is $272,500. And journalize the entry required if the amount of unearned fees at the end of the year is. So when that statement is made, the amount of unearned fees at the end of the year is, and they give a value, that value is how much the company still owes in services to someone else. Remember, we always journalize what we've earned. So we're going to do our calculation here. So we have unearned fees. My liability account is going down. fees earned is increasing. So I originally owed $272,500 in services. I still owe $189,750 in services. So that means during this period of time, I've earned $82,750 in revenue. Again, can't stress it enough. What we're recording here is always what we've earned, because remember, our revenues increase with credits, and when we do our adjusting entries, we're always increasing our income statement account, meaning our revenue or our expense. So two different ways of kind of looking at our unearned options here for our adjustments. The next one tells us that the prepaid insurance account had a beginning balance of $4,500, was debited for another $16,600 of premiums that were paid during the year, and they want us to journalize that adjusting entry at the end of the year, assuming that the amount of unexpired, and that is so important, insurance related to future periods is $5,600. So, again, think about our 5 different types of adjusting entries. We have prepaid adjustments, unearned, 2 types of accruals, and depreciation. Well, we're dealing with prepaid insurance. So if we have a prepaid, it's probably going to require a prepaid adjusting entry. So this is something that was initially recorded as an asset, but is expected to become an expense. So think of this in your own life. If you go ahead and pay your entire year of your insurance coverage on your car on January 1st, you have, as of January 1st, 12 months of insurance coverage. At the end of January, you no longer have 12 months. You now only have 11 months. You've used a month. And after the next month, you use another month. So we need to adjust for that process that we no longer have as much coverage as we previously did. So they told us, we know it's an asset, so it's going to have a debit balance. So we have a beginning balance of $4,500. We had $16,600 in premiums that we paid. So premiums that we have. So as of right now, what's sitting in our asset account in our ledger for prepaid insurance is a total of $21,100 in insurance coverage. But we know that that is not accurate because it says the amount of unexpired insurance related to future periods is $5,600, which means that I only have $5,600 of that asset remaining. So I've used some over that period of time. So let's say this again is December 31st. What we are using is our insurance. So that becomes an expense. And the asset that we're using is our prepaid insurance. So again, remember that a definition of an expense is any asset that we've used to help run and operate our business. And it doesn't always have to be cash. And again, cash is never going to be involved in our adjusting entries. So I had $21,100 of prepaid insurance. I only have $5,600 left. So we subtract what we had versus what we still have to get what we've used. So I've used $15,500 of my prepaid insurance. So if we post that to our ledger here, we know opposites subtract. I'm now left with an ending balance in the account of what is actually unexpired at this time. I think I heard a question pop in, so let me just double check here. Oh, no problem, Kristen, at all. Have a good night. So the next one, it tells us our supplies account had a beginning balance of $3,375 and was debited for $6,450 of supplies purchased during the year. And they want us to journalize the adjusting entry required at the end of the year, again, assuming that the supplies on hand, meaning the ones I can still touch, I still own, is at $2,980. So anytime we use an asset, it becomes an expense. The asset that we're using is supplies, so we now have supplies expense, and we're reducing our supplies. So same process that we had. We had $3,375 in supplies to start. We went out and bought $6,450 more. And by the end of the year, we only have $2,980 in supplies remaining. So that means we've used $6,845 in our supplies. And then finally, it tells us that the estimated amount of depreciation on equipment for the year is $7,700, and they want us to journalize the entry for depreciation. So our journal entry is always the same for depreciation. We debit depreciation expense. And when you're doing your homework in Cengage, really pay attention to the chart of accounts that's being provided to you. Sometimes you'll have multiple depreciation expense accounts. So it might say depreciation expense equipment, depreciation expense building. So just be mindful of that when you're doing your entries. And the amount that they give you is always the amount of your adjusting entry. And then we have our accumulated depreciation, which is always specified because each asset account is always going to have its own accumulated depreciation account of $7,700.